while being slightly fast-paced. The U.S. stock market is currently closed for the weekend. We're looking at SoFi Technologies, ticker symbol SOFI, which ended the trading week on Friday, September 19, 2025, at a closing price of $29.51. This represented a significant intraday surge of 4.98%, a move that pushed the stock to a new 52-week high and has investors buzzing. But the immediate question isn't just why it rallied, it's whether this explosive price action is the culmination of its long-awaited breakout or simply a fleeting moment of market euphoria before a significant pullback. The common narrative paints a picture of a fintech darling finally hitting its stride. But the underlying data, from cash flow statements to institutional sentiment, reveals a far more complex and precarious reality that every investor, whether using a platform like SoFi Invest or a more traditional fidelity brokerage, needs to understand. The tension between the market's expectation of a seamless growth story and the operational realities of a company in hyper-scaling mode is where the true story of this stock lies. The general belief surrounding SoFi has been remarkably consistent. It is the ultimate financial services disruptor, a one-stop shop designed for the modern consumer. The expectation is that by bundling everything from student and personal loans to an online investing platform, credit cards, and even crypto trading through SoFi, the company would create an unassailable competitive moat. Investors, particularly those active on platforms like Robinhood, have been drawn to this story for years, anticipating the moment when user growth would translate directly into sustained GAAP profitability. The recent acquisition of a national bank charter was seen as the final piece of the puzzle, a masterstroke that would lower its cost of capital and unleash a new era of earnings power. This narrative suggests a clear upward trajectory, an almost inevitable ascent, as it steals market share from legacy banks and less integrated fintech players. The nearly 5% rally on a high-volume trading day seems, on the surface, to be a powerful confirmation of this widely held belief. However, this is where the expectation begins to diverge sharply from the much deeper, more nuanced reality of its financial and market positioning. The reality is that while the bank charter is transformative, it is not a magic wand. The recent surge to its 52-week high of $29.63 was driven by a confluence of factors that go far beyond a simple growth narrative. Firstly, the broader macroeconomic environment, with growing optimism that the Federal Reserve will continue its path of easing interest rates, has created a powerful tailwind for lending institutions. Lower rates not only stimulate loan demand, but also ease the pressure on net interest margins, a critical metric for a company like SoFi. The trading volume on its recent run-up was immense, clocking in at over 74 million shares, significantly above its daily average. This wasn't just retail enthusiasm. This level of volume suggests significant institutional participation, perhaps from firms utilizing sophisticated platforms like interactive brokers to build positions. The options market has also been white-hot, with call option volume indicating aggressive bullish bets on further upside. This is where we must challenge the simplistic view. Is this institutional money a vote of long-term confidence, or is it momentum-driven hot money that could vanish as quickly as it appeared? While many are celebrating the new highs, seasoned analysts are cautiously watching for signs of exhaustion, questioning whether this rally is fully supported by the underlying fundamentals or if it's being amplified by market sentiment and short-term macro bets. This isn't just about self-investing in a popular name, it's about dissecting the very quality of the stock's recent momentum. To truly grasp the situation, we must analyze the company's operational structure. SoFi operates through three distinct but interconnected segments. The first and most well-known is its lending division, which offers student loans, personal loans, and home mortgages. This remains the company's primary revenue driver. The second is the financial segment, the manifestation of its one-stop shop ambition. This includes SoFi Money, a cash management account, SoFi Invest for online investment, SoFi Credit Card, and other services. The goal here is to increase the lifetime value of each customer by cross-selling multiple products. This is where it competes with a vast array of companies, from Fidelity Investments with its comprehensive brokerage and Fidelity ETFs, to Robinhood stock trading with its commission-free model. The third and arguably most critical long-term component is the technology platform, anchored by its acquisitions of Galileo and Technisys. Galileo is a leading payments and banking infrastructure provider whose clients include other fintechs. This B2B segment provides a separate, high-margin revenue stream that diversifies SoFi away from the cyclical nature of consumer lending. The expectation is that these three pillars will work in perfect harmony, but the reality is a constant and expensive balancing act of marketing spend, technological integration, and credit risk management. The latest financial reports tell a story of spectacular growth clashing with concerning operational metrics. For the second quarter of 2025, the company reported a stunning 43.9% year-over-year revenue increase and a mind-boggling 458% surge in net income. Earnings per share have also shown remarkable improvement. This is the headline data that fuels the bull case. But digging into the cash flow statement reveals a different picture. Cash from operations was a staggering negative $1.47 billion. This starkly contrasts with the positive net income figure and signals that while the company is profitable on an accrual basis, it is still burning through substantial amounts of cash to fund its growth and lending activities. This is the critical piece of the puzzle that the surface-level narrative often misses. The company is relying heavily on cash from financing activities, essentially raising capital to plug this operational hole. The expectation is of a self-sufficient financial powerhouse, but the reality is that SoFi is still very much in a high-stakes growth phase where external capital is essential. This doesn't negate the company's potential, but it introduces a level of risk that the soaring stock price may not fully reflect. This dependency is a key vulnerability, especially if capital markets were to tighten unexpectedly. Looking toward the future, the outlook is a battleground of bullish catalysts and bearish risks. On the positive side, analysts are taking note. Mizuho recently raised its price target on SoFi stock to $31, citing strong execution and a favorable outlook. The primary catalyst remains member and product growth. As SoFi successfully cross-sells more products to its existing members, its customer acquisition cost per product drops and the stickiness of its ecosystem increases. The expansion of its technology platform is another major potential driver. As more financial institutions, both new and old, seek to modernize their digital infrastructure, Galileo and Technisys are perfectly positioned to benefit. A continued favorable interest rate environment would further bolster its core lending business. The successful rollout of new investment products could also attract more assets under management, chipping away at the market share of established players offering Fidelity mutual funds or Schwab intelligent portfolios. Now is a good time to get your input. Comment below if you believe SoFi's bank charter is its single most important long-term advantage. However, the risks are equally formidable and cannot be ignored. The fintech space is brutally competitive. SoFi is not just competing with legacy banks, it's fighting a multi-front war against specialized players like Robinhood in trading, PayPal and Block in payments, and a host of other neobanks and lenders. Furthermore, its current valuation is steep. With a price-to-earnings ratio hovering around 60, the stock is priced for near-perfect execution. Any misstep, whether it's a slowdown in member growth, a deterioration in credit quality within its loan portfolio, or a failure to achieve operational cash flow positivity in a timely manner, could lead to a severe repricing of the stock. Regulatory risk is another persistent shadow over the entire industry. As fintech companies grow larger and more systemically important, they will inevitably face greater scrutiny and potentially stricter regulations that could crimp their growth and profitability. Investors must weigh the exciting potential of this digital finance leader against the very real possibility that its path forward will be far more challenging than the current market sentiment suggests. In conclusion, the story of SoFi Technologies is a classic case of market expectation versus a far more complicated operational reality. The expectation is that of a fintech juggernaut on a clear and unstoppable path to dominating the world of personal finance. The recent share price performance breaking through to new highs seems to validate this view entirely. But the reality is that SoFi is a company in a delicate high-growth phase, navigating intense competition, significant cash burn, and a valuation that leaves little room for error. The impressive top-line growth and burgeoning profitability are real, but so are the operational cash flow challenges and the macroeconomic dependencies. The ultimate success of an investment in SoFi will depend on its ability to transition from a capital-intensive growth story to a self-sustaining, cash flow positive enterprise. The market is currently betting heavily that it will make that transition seamlessly. The deeper analysis, however, suggests that while the potential is undeniable, the journey is far from over, and the risks remain profoundly real.